Welcome back to the Deep Dive.
It's good to be here.
If you're listening to this, I think there's a pretty good chance that you felt a very particular and I'd say deeply uncomfortable emotion over the last few years.
Oh, I know exactly what you're talking about. It's a unique kind of psychological burden, isn't it?
It is. It's that gnawing guilt of holding cash.
Mm-hmm. You watch the headlines, you see the S&P 500, the NASDAQ, just hitting what feels like a new all-time high every single week.
And you look at your brokerage account, right? You see the market going up, and then you see that stable, unchanging number in your money market fund.
And you feel like you're failing, actively failing.
That feeling is manufactured.
Yeah.
I mean, it's completely manufactured. And it's amplified by this narrative that's just everywhere.
Right. Every financial news channel is screaming the same old lines.
Cash is trash.
Inflation is eating your savings alive.
Exactly. And you see these, mega cap tech stocks and NVIDIA or something just going completely vertical.
Creating this instant paper wealth.
And the pressure just becomes, well, it's intense. It's that pure biological FOMO, that fear of missing out.
And it works. It forces the average investor to, panic buy into the market right at its most expensive, most dangerous peaks, just to make that feeling go away.
Just to silence that guilt.
But that emotional response, it's predictable. And because it's predictable, it's precisely what creates the opportunity for people who are, well, more disciplined.
And that's what we're doing today. We are launching what I think we can call a forensic investigation into this exact thing.
Our mission today is to prove that that guilt is completely misplaced and that let's call it the smart money, doesn't see cash as a drag.
Not at all.
They see it as an active strategic position.
We are flipping the whole premise on its head. The contrarian idea we're unpacking today is this: holding a significant, well-defined cash reserve right now.
Mm-hmm.
It might actually be the most aggressive move you can possibly make.
It sounds paradoxical, but it's true. And we're finding evidence that the masters of the universe, the greatest capital allocators out there, they're not moving to the sidelines because they're scared.
No, they're moving because they are intentionally loading the gun.
So today we're going to analyze the, I'd say, undeniable forensic evidence from the ultimate capital allocator, Warren Buffett himself.
And see how his recent actions really validate this whole idea.
Yeah, and then we'll dissect the mathematical mechanism behind it, this concept called optionality. We'll frame cash as a perpetual call option.
And finally, we'll dive into the psychology, the really hard part, the strategy you need to master JOMO, the joy of missing out.
Which is absolutely essential to make this work.
This deep dive, it's not about fear. It's about being prepared, calculated readiness. So let's start by unpacking that core fallacy.
Okay, let's do it.
The cash trap.
To really get why cash is so strategic today, we have to start by, looking back a bit. We have to understand the context of that cash is trash mantra.
Right, because it wasn't always bad advice.
No, not at all. It was perfectly legitimate, I'd say correct advice in a completely different world, a different interest rate environment.
Yeah, you have to remember the 2010s, and especially that period right after 2020.
Zero interest rates. ZRRP, as they called it.
Central banks were just desperate to stimulate their economies, so they drove rates down to basically nothing.
You were lucky to get, 0.1% on a savings account?
If that. And meanwhile, you had inflation running at 2%, or worse, that huge 5 or 6% spike we saw. So holding cash meant you were guaranteed to lose purchasing power.
Your money was literally decomposing. It was melting in real terms.
Ray Dalio made that phrase famous: cash is trash.
And in that zero-rate world, he was 100% correct. The whole system was engineered to punish savers.
It was designed to force your capital out onto the risk curve into more speculative assets just to get any kind of return.
And that, of course, led to massive asset inflation, pushed valuations higher on everything.
The problem, and this is the core of the trap, is that the narrative is sticky. It's like a bad habit that just refuses to die, even though the entire financial reality has changed.
That's it. The retail investor is still operating on let's call it the trauma of 2020. They still believe that cash is a guaranteed loser.
And that psychological lag, that's what leads directly to this cash trap fallacy.
And the fallacy is all about how you define cash. I mean, it really is that simple.
How so?
For the retail investor, for the herd, cash is defined by one thing: opportunity cost.
Ah, right. They're constantly doing that painful math in their head.
Exactly. How much money could I have made if that $10,000 had been in NVIDIA for the last 3 months?
And that calculation is just brutal. It generates that visceral FOMO we talked about.
Which leads to emotional reactive decisions, chasing momentum.
And then they do it. They dump their precious safety net into the market right when prices are at their highest. They convert their liquidity into very expensive, very illiquid risk.
But the strategic investor, the disciplined allocator, they use a completely different vocabulary.
They don't call it cash.
They define it as dry powder.
It's an active term.
Completely active. It's not some useless leftover in your account. It's capital that you have specifically reserved for deployment during moments of, extreme market distress, asymmetrical opportunities.
I think we really need to hammer that reframing home. This isn't about being afraid of the market going up.
Not at all.
It's a deliberate, calculated choice to hold capital. That is, as you said, waiting in the sniper's nest.
It just transforms cash from this passive liability into an active, strategic part of your allocation. It's a position designed specifically to generate huge returns when volatility spikes and everyone else is panicking.
And we are seeing, concrete macroeconomic warning signs right now that really validate this move.
We are. You have record valuations in the S&P 500. We're talking about indexes trading at near historic high multiples.
And under the surface, you've got rising geopolitical chaos, you've got these stubborn inflation concerns, and a lot of uncertainty about what central banks are going to do next.
The smart money isn't waiting for the all-clear signal. They're responding to the current prices and the current risks.
They're reading the same headlines as everyone else, but drawing the opposite conclusion.
Instead of chasing the last, 5 or 10% of a rally, institutional players are quietly selling into this rally.
They're taking profits while prices are high.
They are liquidating their equity exposure to hoard liquidity.
And this is so critical to understand. It's a deliberate move to de-risk.
They are not trying to do the impossible, which is to time the exact top of the market. They are simply recognizing that at these valuations, the risk-to-reward calculation
It's just not attractive anymore.
Not at all. The potential upside of, say, another 5% gain is just dwarfed by the devastating potential downside of a 20 or 30% correction.
So they're trading that speculative maybe gain for the guaranteed safety and the powerful optionality of cash.
And that behavioral shift, that's the first major piece of evidence in our investigation.
Which leads us directly to the gold standard of this whole way of thinking.
When you want validation for a huge strategic shift, you don't look at, TikTok gurus or hedge funds that are just focused on the next quarter.
Yeah.
You look at the ultimate example of long-term disciplined capital allocation. You look at Warren Buffett.
Whose strategy is just so simple. It's brilliant. Buy great deals when you see them.
And patiently wait when you don't. Waiting is part of the job.
And waiting is exactly what he is doing right now. But on a scale that forces the entire financial world to sit up and pay attention.
This is the hard forensic data. As of the latest filings, his company, Berkshire Hathaway, is sitting on a record pile of liquidity.
What's the number?
It exceeds $180 billion in cash and short-term treasuries.
$180 billion.
To put that in perspective, that's bigger than the entire GDP of many small countries.
So when a company whose entire reason for existing is to find and buy undervalued businesses, when that company is holding that much cash.
It is not an accident. It's a profound, unambiguous signal to the entire global market.
Okay, I have to challenge this because this sounds like the very thing we tell retail investors not to do.
Go on.
Isn't this just market timing? The old saying is, time in the market beats timing the market. So how is Buffett hoarding all this cash different from him just trying to predict a crash?
That is a fantastic and crucial distinction, and it's why you have to understand his philosophy. He is absolutely not timing the market in a predictive sense.
Okay.
Timing the market is saying, I believe the market will crash on October 25th, so I will sell everything on the 24th. That's fortune telling.
Which is impossible.
Impossible.
Yeah.
Buffett is simply sticking to a strict discipline based on value. If the price of an asset goes above what he calculates as its intrinsic value, his hurdle for buying, he just stops buying, or he starts selling.
So his record cash pile is just the end result of him not finding anything cheap enough to buy.
Yeah. And selling things that have become too expensive. It is valuation discipline, not market prediction.
Got it. That makes sense.
So let's think about the implication of that selling. That 180 billion had to come from somewhere.
Right.
The man who famously says, never bet against America, is right now unequivocally betting against the current valuations of American companies.
He's not anti-America, he's anti-price.
Exactly. And we've seen him trimming major positions he's held for a long time.
Apple's the big one.
Apple, for example, it had grown into such an enormous part of the Berkshire portfolio that its sheer size was becoming a risk in itself.
Concentration risk.
Right. So trimming Apple wasn't necessarily a comment on Apple's future. It was a comment on its current price relative to its future growth, and crucially, a way to raise dry powder at historic highs.
He's also been selling banks.
Significant stakes in banks, yes. And banks are very sensitive to the economic cycle and credit risk.
So about trimming those cyclical, valuation-sensitive assets.
He is systematically liquidating equity that he thinks is fully valued, and he's storing the cash in risk-free short-term treasuries. He's hoarding liquidity. He's positioning himself to be the future buyer of last resort.
And while he obviously has his own internal, secret metrics, there is one public metric that really captures his worldview, and we know he watches it.
And it is flashing a severe warning right now.
The Buffett Indicator.
The Buffett Indicator. It is maybe the most elegant, powerful, top-down valuation metric there is.
And how does it work? What is it exactly?
It's a simple ratio. It's the total stock market value divided by the gross domestic product, the GDP.
So in simple terms, it's comparing the financial paper value of every stock in the country
against the real-world economic output of that country, what America is actually producing.
And historically, what's a normal level for this indicator?
Well, when the ratio is around, say, 75 to 100%, the market is generally seen as fairly valued, maybe even a little cheap. When it starts getting past 120%, historical data shows we're entering dangerous overbought territory.
And what about before past crashes?
Right before the 2000 tech bubble crash, it peaked around 150%. It spiked pretty high before the 2008 financial crisis as well.
Okay, so the big question, where is it sitting today?
It is currently flashing alert red.
Wow.
It is sitting approximately 2 standard deviations above its historical norms. Depending on the exact calculation you use, it's often reported at well over 180, sometimes even 200% of GDP.
2 standard deviations. For anyone who's not a statistician, that basically means we're in a statistical outlier. This is not a normal environment.
Not even close.
Yeah.
And it confirms his behavior perfectly. Buffett is refusing to play a game where the price of admission is wildly inflated compared to the underlying economic reality.
He's not trying to squeeze out that last 5% from what looks like a bubble.
So, his $180 billion cash pile is the direct, practical result of this indicator flashing red. It's not fear, it's discipline.
He believes the deals will be much better in the future.
And he needs to have the capital ready to act when that happens. He's building his dry powder fortress right in front of us, validating this whole thesis.
And that evidence transitions us perfectly into the why. The mathematical reason that cash represents so much power.
For most investors, the mental picture of cash is, it's a stagnant asset. It's a painful reminder of gains they missed.
Yeah, that opportunity cost again.
But we have to make that mental shift now. Strategic cash isn't idle. It's a sophisticated financial instrument. It is, in effect, a perpetual call option.
I love that framing because it immediately gives cash an active, valuable identity.
It does. And for anyone not familiar with, complex derivatives, a call option gives the holder the right, but not the obligation, to buy an asset at a set price.
The strike price.
Before a specific date, the expiration date.
So let's apply that framework to our dry powder. How is cash like a call option?
Well, cash is the ultimate call option because it has 2 incredible features that normal options don't have. First, it has no expiration date. And second, it has no predetermined strike price.
Ah, okay. So it grants you this unlimited perpetual right to buy any asset. Stocks, real estate, crypto, whatever.
The moment that asset crashes and the price becomes attractive, the market, through its own cycles, sets the strike price for you. You hold maximum optionality.
Okay, but hang on. Every option has a cost, right? There's a premium you pay for that right to buy.
Good question.
Earlier, we talked about inflation eating your savings. So isn't the cost of this perpetual call option Just the inflation rate?
That's a brilliant challenge. And historically, yes, the cost of holding that option was inflation.
Right.
When you held cash earning 0.1% and inflation was 2%, you were effectively paying a 1.9% premium every year to hold that optionality.
And that's a high price to pay, which is why cash is trash made sense back then.
Exactly. But the current environment has completely changed the math. We'll get deeper into this later, but since cash now yields 5%,
And inflation is trending down.
you are essentially paying zero. Or you might even be receiving a net positive premium to hold this perpetual option.
So you're getting the optionality for free, or you're even getting paid to hold it.
And that free optionality is the bridge to building massive wealth. Just contrast that with the investor who's fully invested, the one who gave into FOMO and is 100% in equities at all-time highs.
They have zero dry powder.
Zero optionality.
They're totally committed.
Yeah.
If the market tanks 40%, which we know is a real possibility, the fully invested person is just a victim.
Their entire portfolio just evaporates in net worth. They have absolutely no ability to take part in the massive, generationally significant sale that always follows a crash.
They're trapped. They just have to hold on and hope it comes back over the next 10 years.
And worse, if they need cash for a real-life emergency during that time, a job loss or a medical bill,
They're forced to sell their stocks at the absolute bottom.
locking in those massive losses, cementing their status as a victim of volatility.
But the strategic cash holder, the person with, say, 30 or 50% in cash equivalents, they are the predator.
They view the crash not as a tragedy, but as a golden opportunity. That optionality means they get to dictate the terms.
They choose what to buy, when to buy it, and at the steepest possible discounts.
And this power comes from a core truth about the financial system. Liquidity is the oxygen of the system.
Normal times, it's everywhere. Money flows freely, borrowing is cheap.
But when a crisis hits, the whole system just seizes up. Banks stop lending, margin calls force selling.
And everyone rushes for the exit at the same time, desperate for one thing: cash.
That's the moment. When the market panics and everything sells off indiscriminately, even high-quality stuff, that's when liquidity vanishes.
And that is when the cash holder becomes king.
Absolutely. The person with liquidity is the only one who matters. They have the power to buy dollar bills for 50 cents from people who are forced to sell in a panic.
This is the moment. This is how you execute a massive one-time capital deployment that can create generational wealth.
Because generational wealth isn't really built by just buying the index at a high PE and holding for 30 years. I mean, that's fine.
But the big leaps,
The big leaps are made by taking decisive action at the moment of maximum fear. It's built by buying aggressively at the bottom when there is blood in the streets.
and that cash position, that's the tool that lets you go from being a patient accumulator to a decisive predator. Without that dry powder, the greatest sale in a decade just passes you by.
So the strategic case, the mathematical case, it's overwhelming. But it is completely useless without the third pillar.
The psychological discipline.
Yes. The primary enemy of the cash position is purely internal. It's the constant grinding pressure from FOMO.
And we can't just write off FOMO as, a bad habit. It is an incredibly powerful, almost biological drive.
It is. We have to remember how our brains evolved. For our ancestors, if you got separated from the herd, you were exposed, vulnerable. It often meant death.
So your brain is literally hardwired to generate intense anxiety and stress when the herd is stampeding in one direction, like a bull market rally, and you're just standing still on the sidelines.
And that's the critical paradox of modern finance, isn't it? The survival instinct that worked for cavemen is the exact thing that leads to poverty in today's markets.
In biology, separating from the herd was death.
In finance, being with the herd, especially when they're all piling into overvalued assets, often leads to guaranteed pain when the music stops.
So the disciplined investor has to actively fight their own biological programming.
You have to cultivate the opposite mindset. You have to cultivate JOMO, the joy of missing out.
Which means retraining your brain to get actual pleasure, real validation from watching a bubble inflate from a position of total safety.
And that takes extraordinary mental strength. I think we've all been there.
Oh, yeah.
You're holding fast to your principles, you've got your cash position, and then you watch a friend who took some wild speculative bet, a meme stock or something.
And they're bragging about making 50% in a month.
Right.
I remember so vividly during that post-COVID frenzy, seeing people make just staggering amounts of paper money on things that had no fundamental value.
And it creates that internal burning question. Am I an idiot?
Am I missing the new paradigm?
Yeah.
It took so much effort not to deploy capital into things I just knew deep down were bubbles. That is the real test of this strategy.
That is the patience that's required. You might have to sit on your hands, enduring that internal pressure, that external social pressure, for maybe 2 years while the market keeps partying without you.
Patience during a crisis is easy. Everyone's scared together.
But patience during a booming rally is incredibly hard. You feel isolated, you feel foolish.
Let's use that party analogy from our sources again. I think it really makes the point stick. The stock market is a massive, wild party.
The first non-negotiable rule of this party is that it always ends. Every single bubble, every euphoria, it eventually pops.
And when the music stops, the hangover is paid for by the people who showed up last.
The smart money, the Buffetts, the big institutions, they leave the party early. They cash out while the champagne is still flowing, maybe around 10 p.m.
They've made their money, they've avoided the mess, and they're home sleeping soundly.
But the retail investor, driven by that acute FOMO, they show up late, like 1 a.m. late.
They rush in, fueled by all the excitement, buying the last, most expensive assets, often on margin.
Just before the cops show up and shut the whole thing down, they pay the highest price and they absorb the steepest losses when the market turns.
So cultivating JOMO means you have to accept that leaving a little too early or refusing to show up when things are obviously overpriced, that's not a failure.
It is supreme risk management. JOMO is the cognitive tool that helps you fight that biological urge to buy high so you can wait for the inevitable chance to buy low.
And you need that psychological resilience because the dry powder position only works if you can actually maintain it.
Right. If you have 30% cash but you panic and throw it in at the first minor dip, or you just get tired of waiting, you lose the optionality completely.
The discipline has to hold until the moment of maximum panic. And JOMO is your shield against giving up too soon.
You have to believe, fundamentally, that you are being smart by sitting out the exuberance.
Okay, so we've covered the strategy and the psychology. Now let's circle back to the math, because the current economic environment has given cash holders this huge advantage that just wasn't there during the cash is trash days.
As we touched on, the old pain point was zero interest rates. Your cash was a melting ice cube.
That pain point is gone.
Completely gone, because the Fed's fight against inflation forced them to hike the benchmark rate so drastically.
And the fundamental change is that today, you can get a risk-free return of between, 4.5% to 5.5% on your cash reserves?
Yeah, through very liquid things like high-yield savings accounts, money market funds, or short-term U.S. Treasuries. This isn't a small change. It's a seismic shift in valuation debate.
And let's quickly break those down because the safety of where you park that cash matters.
Yeah, it does. A money market fund pools cash to buy ultra-safe short-term debt, things like commercial paper or short-term treasuries. They're highly liquid.
And then there are T-bills.
Short-term T-bills, like a 4-week or 8-week bill, are direct loans to the U.S. government. They offer the highest safety, maybe slightly less daily liquidity than a money market fund, but you still get that crucial 5%-ish yield.
And that 5% risk-free return, that introduces a concept that should govern every single investment decision you make right now.
The hurdle rate.
Explain that for us.
The hurdle rate is the minimum acceptable rate of return an investment needs to achieve before you even consider taking on any risk.
And since you can now get a guaranteed liquid 5% return with zero risk,
that 5% becomes your absolute minimum benchmark. That's your hurdle rate.
So the math is simple. For any stock, any piece of real estate, any investment to be worth buying today, it has to realistically and reliably beat the 5% you can get for doing absolutely nothing.
And this just instantly filters out huge parts of the market. Think about a stock trading at a high valuation.
Yeah.
For that stock to be a good bet, it needs an expected annual return of, say, 8 or 10%.
So you're taking on company risk, market risk, geopolitical risk, all for a potential premium of just 3 to 5% above the risk-free rate.
It just doesn't make sense for a lot of assets right now.
Let's apply this to, say, a REIT, a real estate investment trust. A solid one might pay a 4% dividend.
In the zero-rate world, 4% looked amazing.
But today, why would you buy an illiquid REIT with all its market and occupancy risks for 4% when you can get 5% guaranteed from the U.S. government?
The hurdle rate makes that 4% asset completely unattractive.
And the same goes for those high PE growth stocks.
A super hype tech company might be trading at a price-to-earnings ratio of 50. That means the company has to grow its earnings dramatically for years just to justify today's price.
And if growth slows even a tiny bit,
Those paper gains can evaporate overnight. The risk you're taking is huge compared to the guaranteed accumulating yield you get by staying liquid.
This high yield, it lets us adopt that strategic mindset. We are being paid to wait.
Yes. The 5% yield is a cash dividend paid to us for our patience. It means our dry powder isn't static, it's not eroding, it's actually accumulating more powder while we wait.
Constantly increasing our future buying power.
This is the genius of the cash shield. It gives you this powerful dual benefit. First, it's defensive.
It protects your downside from volatility. If the S&P drops 20%, the cash portion of your portfolio is completely stable, untouched.
Second, and this is the offensive part, it simultaneously guarantees you an upside. That 5% yield ensures your purchasing power is growing at a rate that's highly competitive with equities, but with none of the downside risk.
It's defense and offense in perfect sync.
And the ability to get a competitive risk-free yield while holding maximum optionality. That's why the world's best investors are comfortable holding so much liquidity right now.
They're getting paid very well, with almost no risk, to watch this highly valued speculative party from a safe distance.
Waiting for the inevitable sale.
So we've reached the final verdict of our forensic investigation. Cash is not passive. It's not a sign of panic.
It has to be seen as an active strategic allocation, a tactical position that's designed to be deployed.
And I think the core question every listener has to ask themselves honestly is the ammunition check. If you are 100% invested in equities or other risk-on assets, you have, by definition, ensured you have no ammunition for the next major market battle.
You've committed all of your capital at high valuations.
But knowing you have that dry powder, that ability to act when everyone else is frozen by fear, that the psychological comfort is just invaluable. Which brings us to the big debate.
How much is the right amount?
In this specific economy, with a 5% yield and sky-high prices, how much cash is just right?
There is, of course, no single correct answer for everyone. It depends on your age, your time horizon, your goals, your risk tolerance.
But we can look at what sophisticated allocators are doing when they think the market is overvalued, which the Buffett Indicator confirms.
And what we see is that they're not suggestive selling everything and going 100% cash. That would be reckless market timing.
Right.
But they are building substantial defined reserves. The debate usually centers on a range that shifts the balance pretty dramatically away from full equity exposure.
What kind of range are we talking about?
A strategic reserve often starts at around 20% of your investable assets.
Okay.
For someone who's more conservative or maybe closer to retirement where you have to protect your principal, that allocation might stretch to 40%.
And that percentage, that is the portion of your portfolio that lets you sleep well at night.
Exactly. Because if you know that even if the market suddenly drops 30%, you're protected, and you have 40% ready to deploy. It just fundamentally changes your relationship with volatility.
Yeah, the person who's 80% invested takes a huge paralyzing hit.
But the person who's 60% invested takes a smaller hit and is simultaneously getting ready to go on offense. They're about to lower their cost basis dramatically on high-quality assets.
So that cash reserve is a defensive tool that's waiting for an offensive deployment.
And that powder can only be deployed when the conditions are right. It requires the sniper's patience.
So detail that sniper strategy for us. You're lying in wait. What are the signals you're looking for?
You are waiting for a severe market correction, a signal event. You're looking for extremes in fear, not just a minor dip.
So you're looking for things like the VIX, the market's fear gauge, spiking dramatically, like above 30 or 40.
Exactly. You're looking for headlines that scream, end of the world, or financial system collapse.
You're waiting for that day when your normally calm friends are panic selling on social media.
When the news is filled with people using phrases like unprecedented losses or worst day since 2008.
That is the moment.
That is the moment. That level of psychological distress and forced emotional selling from the herd, that's what creates the conditions for the strategic cash holder to deploy their position.
That's when valuation stops mattering, and only liquidity does.
And that is when the ammunition you built today, the cash you held through the pain of JOMO, is finally fired, securing assets at massive generational discounts.
And the final warning here has to be, do not let yourself be psychologically bullied by the market.
Yes.
Don't let the irrational optimism of a bubble coerce you into participating just because the TV tells you your cash is trash. If the price doesn't make sense relative to the 5% risk-free rate, the right answer is to wait.
Patience is capital.
The future belongs to the owners, but the wisest owners are the ones who buy at the steepest discount, not the ones who give in to the pressure to buy at the steepest premium.
The power of optionality, the validation from Buffett's record cash pile, and that protective, accumulating yield of the current interest rate environment. They all point to the same strategic conclusion.
Dry powder is the position to hold right now.
Thank you for joining us on this deep dive. We've covered the evidence, the math, and the psychological defense. But before we let you go, we want to leave you with two critical questions to think about this week.
The first one is about your own investment philosophy. Is it truly timing the market, which we all agree is a bad idea, if you are simply refusing to buy assets that historical metrics clearly show are wildly overvalued?
Or is refusing to pay an exorbitant price just common sense, just disciplined capital management? Where do you draw that line for yourself?
And the second question is the real litmus test for your readiness. If the stock market crashes a significant amount, let's say 40% tomorrow morning, do you personally have the cash, the psychological resilience, and the intentional plan you made today to actually buy that dip?
Yes or no?
That answer, you'll find, really dictates whether you're prepared to be the victim or the predator in the next great financial cycle.
Until next time, keep your powder dry.